John Ulzheimer is known as one of our nation's most recognized credit experts. Having worked for 28 years in the credit industry, John has become one of the most prolific speakers about credit and the go-to authority on answers to credit-related questions. Credit Countdown with John Ulzheimer.
Hello, my name is John Ulzheimer. I'm a consumer credit expert in the credit industry for almost 30 years now. Spent time at FICO, which is the credit scoring company, and Equifax, which is one of the three generally recognized credit reporting agencies. Today we're going to talk about the difference between secured and unsecured credit. We're going to talk about some different examples. We're going to talk about the value of both types of credit to your credit reports and scores, and then we're going to talk about some things that you should be careful about with respect to both types of secured and unsecured credit. All right, so let's define secured, and then we will be able to easily define unsecured. Secured credit is any form of credit that has some sort of a physical asset that is put at risk by the borrower should they default on a loan, okay? So it is essentially guaranteeing the loan to some extent, which is called securing the loan. I'll give you a great example. So when you apply for a car loan, what happens if you don't make the payments on your car loan? The lender, who is technically the owner of the car until you have paid it off, the lender wants that car back. So that car is securing the loan, and they come get it through the process called repossession. Similar things happen to mortgage lenders. The home, which is actually owned by your mortgage lender until you pay it off, is securing the loan. So if you don't pay it, they're going to want that back. They're going to kick you out. They're going to want to sell it to someone else who perhaps will make the payments, and that's called foreclosure and then eviction. So those are examples of secured types of loans, something where there's a physical value that can be taken away from you if you don't make the payments. There are other examples of this, asset borrowing. So in other words, pawn shop loans, title loans. I'm sure you've seen the commercials, get your title back. If you don't make payments on those loans, the company has your title of your car, so technically they're the owner of your car. Borrow money from a pawn shop. Usually you bring in some interesting piece of artifact or collectible, and the pawn lender will let you borrow money against it. And if you don't pay them back, then they get to keep whatever the asset is that you brought in. So those are all examples of secured, and we'll do a little quiz here in a second just to see how well you've grasped this concept of secured. Unsecured is when there is no asset that can be taken back if you default. So a great example would be something like a student loan. What is the lender going to come back and take if you don't make payments on your student loan? They can't come take the education that you have. So that's a great example of an unsecured extension of credit. So let's talk about what these actually mean as far as consumer risk. Secured, look, no one wants to get kicked out of their house. No one wants to lose their home. No one wants to lose their car. No one wants to lose their motorcycle. No one wants to lose their boat. No one wants to lose land. These are all assets that are commonly pledged by a borrower to help to secure a loan. No one wants to lose those things. As such, secured loans tend to be more stable. People tend to default on them less often because they don't want to lose whatever it is, the asset that they pledged to the lender. Unsecured is a very different animal. Unsecured, for example, credit cards, there's nothing for the lender to come take back, so they essentially eat it, which is why interest rates on credit cards are so much higher than they are on loans of much larger dollar amounts, because one is a higher risk of lending and one is a lower risk of lending, okay? So let's talk through some examples. Auto loan, is auto loan secured or unsecured? It's always secured. Credit cards, secured or unsecured? Well, that's going to be both. You can get a secured credit card, you can get an unsecured credit card. A secured credit card occurs when you put a deposit down with a bank and then you get a credit card that has a credit limit that's equal to or very close to your deposit amount. So you give them $300, you get a credit card back from them with a $300 credit limit. It's fully secured. You've already kind of prepaid for the card, if you will, even though it's not a prepaid card. And if you default on whatever teeny weeny little amount of debt you have on the card, they have the right to offset that loss with the deposit that you made. So it's almost like guaranteeing the payments on a credit card. Student loans, definitely unsecured. Mortgages, definitely secured. Home equity lines and home equity loans, always secured. The word equity indicates that it's secured because it's value of your home that's not already encumbered by a debt. So if you have a house that's worth $500,000 and you only have a $200,000 loan, you have $300,000 of equity and you can borrow against that. So it is in fact secured, it's just secured by the value of your house. Personal loans are normally unsecured. So unsecured personal loans are very popular these days. They're great methods to pay off more expensive credit card debt. They're installment loans, and so they're less problematic for your credit scores. Personal loans are normally unsecured. Certainly a bank can structure a personal loan so that it is secured, but in most cases they are in fact unsecured. So the value to your credit reports. The value to your credit reports and credit scores is equal regardless of whether it's secured or unsecured. You're not penalized because it's unsecured. You're not rewarded because it's unsecured. And you could say the same for both. So there's really no credit score benefit by choosing one or the other. Obviously there are other attributes. For example, credit cards are treated very differently than mortgage loans. Personal loans are treated very differently than auto loans. And so from that respect, then they do have a different value to your credit reports and scores, but it really has nothing to do with the fact that one is secured and one is unsecured. So I'm going to end you with kind of a warning. And the warning is regarding secured credit card accounts. Secured credit cards are a very common method of people to establish credit and rebuild credit once they've gone through some sort of a credit disaster. The reason is because they're very easy to get, because you're essentially making a deposit with the bank and you're almost buying the account, so to speak. So the challenge is how do you use these cards in such a way that they don't damage your credit scores? And the way that you can prevent any damage to your credit scores to understand what the credit limit is on the credit report. Secured cards always have very low credit limits. No one's going to plop down $10,000 or $20,000 just to get a secured card with a $10,000 or $20,000 limit. That doesn't happen. Usually it's $300, $500, $700, really low credit limits. Because the credit limits are so low, it's really easy to heavily utilize the card even for modest purchases. Heavily utilized credit cards are not good for your credit scores. So be very, very cognizant that you may chew up a whole lot of your credit limit, even making modest purchases, which is why secured cards as a long-term strategy are probably not the best idea. Unsecured credit cards that have $10,000, $20,000, $30,000 credit limits make it so much easier to use those without having to worry so much about really heavily leveraging that card. So if you have any questions about secured versus unsecured, drop them in the comments section below. I'll do my best to answer them. It was my pleasure speaking with you. Have a great rest of your day.
For more videos and credit tips from John Ulzheimer, go to www.tradelinesupply.com.